Did you know that real estate is considered an alternative investment and that the world of PE is based on this fact? Private equity managers often earn millions in fees even if the fund loses money. Welcome to the world of private equity, where some people profit even when investments tank. So, what exactly is private equity? Think of it as investing in companies that aren't on the stock market. Unlike buying shares of Apple or Google, private equity deals with businesses that are privately owned. There are different flavors of private equity. One common type is the buyout, where a private equity firm buys a controlling stake in a company, often using debt. That's where the term leveraged buyout, or LBO, comes from. Another type is venture capital, which focuses on investing in early-stage, high-growth companies, often in the technology sector. Growth equity is similar, but it usually involves investing in more mature companies that are already generating revenue. And then there's distressed investing, where firms invest in companies that are facing financial difficulties, hoping to turn them around. All these funds have a limited life cycle. So how do these private equity firms actually work? They're usually structured as funds with two main players: general partners, GPs, and limited partners, LPs. The GPs are the managers of the fund. They find the companies to invest in and make the investment decisions. The LPs are the investors. Think pension funds, endowments, sovereign wealth funds, and wealthy individuals. They pool their capital together, committing money to the fund, and the GP then uses that capital to make investments. The GPs get paid through management fees, a percentage of the total assets managed, and carried interest, a share of the profits generated by the fund. The investment process is quite involved. First, the deal team needs to find potential companies to invest in. This is called deal sourcing. Then, they conduct thorough due diligence, which is like a deep dive into the company's financials, operations, and market position. Valuation is crucial. They need to figure out how much the company is worth. Once they've decided to move forward, they negotiate the terms of the deal and execute the transaction. After the acquisition, the private equity firm works closely with the company's management team to improve its performance, often focusing on operational improvements, strategic repositioning, or add-on acquisitions. They might use financial engineering to optimize the company's capital structure. When it comes to returns, private equity firms aim for high returns, measured by metrics like IRR, internal rate of return, and MOIC, multiple on invested capital. They look at key financials like EBITDA and revenue to assess a company's profitability and growth potential. Eventually, the private equity firm needs to exit its investment. Common exit strategies include an IPO, initial public offering, selling to a strategic buyer, another company in the same industry, or a secondary buyout, selling to another private equity firm. Of course, there are risks involved. Market risk, regulatory risk, and the possibility that the investment simply doesn't perform as expected are all factors to consider. That's why compliance and fiduciary duty are so important in the private equity world. We've covered a lot in this video, but some questions remain. How are private equity firms adapting to ESG, environmental, social, and governance concerns? How is the rise of alternative investments impacting traditional asset management? What are the long-term effects of private equity ownership on companies and their employees? These are topics for another video. If you found this video helpful, please like, share, and subscribe to our channel for more insights into the world of finance.